Welcome, everyone. We today are going to talk about Social Security, which has always been somewhat complicated and causes a lot of questions for everyone. So hopefully today we can get a lot of your questions answered. My name is Terry Hecker. I'm a wellness and benefits consultant for the Medical College. And with us today, we have Celeste Miller and Mark Lash, who are in our retirement and 403B benefits area. And then also today we have Tim Shirk from Francis Investment Council. And he has done a number of sessions for us. We're excited to have him back. He's a plethora of knowledge. I learn something every time he does our presentation. So couple housekeeping items today real quick. You are all muted upon entry. So any questions you have, I would ask you to please enter them in the Q&A. Or the chat, whichever one you can find. We will try and track all of those for you. And what our plan is to have all of the questions answered at the end of the session. So we're gonna dive right in, but please put your Q&As into the Q&A or chat box. And we'll get to the questions towards the end of the session. So we'll get started and I will hand it over to Tim.
All right, thank you very much. You should be hearing me now, hopefully. And okay, I'm the presenter. That means I should be able to share. Look at this. Let's see. All right, Terry, let me know when you're seeing a blue screen that says maximizing Social Security benefits. All right, fantastic. Well, thanks everybody for joining us today. I appreciate it. My name is Tim Shirk. I am a money advisor with Francis Investment Council. I've been brought in by the Medical College Wellness Group to help you understand Social Security benefits and to maximize your Social Security benefits. You've been paying into Social Security every year through your FICA taxes, so we want to make sure you get as much out of it as you in fact can. So that's our goal today. You will know from previous meetings with me, if you've been in my meetings before, I much rather being live. I love engaging folks on site. But since we can't do that today, I am going to ask you to engage with some polling software. If you can get to a browser without leaving this meeting, please go to www.pollev.com. And then once you get there, enter into the meeting box, Timothy Shirk 857. That's my name, Timothy Shirk 857. Once you do that, you'll be linked with the meeting. Anytime there's an open slide with an open question, if you type in your answer, it'll be included with everybody else's on the screen. Or if you prefer, you could join by text. Text my name, Timothy Shirk 857 to 22333. Timothy Shirk 857 to 22333. That first text will link you with the meeting. From then on, if there's a question up, you can just text in your answer. It will be included with the meeting, in the meeting with everybody else's. It is anonymous, so nobody will be able to see your answer. Terry mentioned about the questions. If you had a question that's specific to you and you didn't want it to ask it in front of the group, feel free to email that question to Terry. She can forward it to me. Or my email address does appear at the end of the screen, on the last screen, so you can write down my email address. So if there's something specific to you that you want to ask, feel free to do either of those two things. So let's see how this audience interaction works. I want to ask you, what concerns you the most when you think about Social Security? You can join by going to pollev.com and typing my name, Timothy Shirk 857, into the box. Those instructions are at the top, or you can text Timothy Shirk 857 to 22333. And then once linked with the meetings, you can text in your answer. Getting my full benefits paid, having enough money to retire, that it will disappear by the time I retire. We're going to address all of these so far. Will it be enough? That we'll address part of. We'll show you where to find out how much you're going to get. A lot of similar things. It's confusing. Is it going to be there? Will it be enough? So my goal today is to help you, first of all, know the basics about Social Security. And part of that will be, how can you find out what your Social Security benefit's going to be? It used to be, you got this statement, this paper statement, you can open it, and there it is. Well, that's what I'm going to receive. Well, you can still get that information. They're just not sending it out. All right. So delayed and disrupted entry into the workforce. Okay, we're going to help you figure out how do they calculate how much my benefit is? And part of that has to do with how much time you spent in the workforce. All right, so I think we're all getting it. I think you guys have concerns that are common to most folks. Again, if there's something that you are concerned about that doesn't quite get addressed here, text in your question to the Q&A or chat box, or send an email to Terry after we're done here. All right, so the two kind of main points we're going to talk about, the basics of Social Security. This is where we'll get most of the questions answered about how does Social Security work, how much am I going to receive, that kind of thing. And then we're going to talk about maximizing those benefits. So we'll look at how can you take your individual situation and get the most out of your benefits. So let's start with the question, OASDI, that is the Social Security system, OASDI. What does it stand for? Does it stand for one's allowed security deserved income, text A? O, American savings did increase, text B. Old age survivor disability insurance, text C. Old adults special deposit income, text D. Or old accountant special deserved income. If there's an accountant out there, I will expect E to be answered. There's typically one accountant in each meeting. All right, you guys are sharper than that. OASDI actually stands for Old Age Survivor Disability Insurance. And if you're getting close to 62 and you're saying, that doesn't describe me, you're not alone, okay? Most folks don't think of themselves at 62 as being old age or survivor or disability, but what that represents a broad range of things that Social Security does. Not only is it the retirement system that we classically think of, but it covers survivors for if you have a deceased worker. It covers disability for a person who's disabled. So there's a pretty wide range of coverage, but usually what we think of the most is the retirement portion. All right. So the first question most folks ask is, will there even be Social Security there for me, right? Very common, especially with the younger folks. And I can say with my own personal certainty, pick a word there that works, that it will be there. However, it may not look like what they promise. What do I mean by that? We think of Social Security as a forced savings, and it really isn't, all right? What Social Security is, it's a flow through, it's a pass-through process. This year, all of us who are working, we pay FICA tax. It's about 7%, it's a payroll tax, about 7% of our income. That goes into the budget. From that same amount of dollars, beneficiaries, retirees, disabled beneficiaries, survivors, dependents, they all draw their current benefits out of that same flow of money. Historically, we've had a lot more money coming in than needed to pay the beneficiaries out. But guess what's happened? Baby boomers have kept aging, and they're a big demographic. They're a big bunch of folks. As they get into retirement, more and more folks are doing benefits. Fewer and fewer folks my age, the Xers, fewer and fewer of us are paying in, more and more drawing out. And as a result, there's been this demographic shift that means that there's not going to be enough going in to pay all the benefits coming out. Now, if the last time you looked at your projection, if you looked at it online, I'll show you where to do that in just a moment. Right under the text where they tell you what the amount will be at 62, full retirement age 70, there's a little paragraph that says this projection is based on current tax law. If nothing changes by the year, and it's somewhere around 2034, we're only going to be able to pay 79 cents per dollar of what we've promised. Okay, that just reflects the demographic shift, right? Now, I've seen that number as low as, I want to say 72 or 73 cents per dollar. It's actually gone up in the last couple of years. Partly, I think, because they've increased the Social Security wage base, so they're taxing a higher income amount. But if you want to be cautious, some folks plan without Social Security, and that's fine. That's great. That's the best way. But if you want to plan for Social Security, but just be cautious, multiply what they're promising you times 0.79. You'll derate the expectation. However, there are a lot of ways that we can fix Social Security. This is not the hardest problem facing our leadership today, all right? One of those could be the reduction in benefits that we just talked about. The other could be an increase in taxes. They could increase the FICA tax a little bit. And, you know, without making a political statement, I just put your mind in the head of a politician whose primary goal is to get reelected. You know, the first moment that anything comes out of your mouth that says we're going to reduce Social Security, your chances of being reelected have just gone down dramatically. I think it's much better, and appropriately so. I think it's much better to make sure we give people what we've promised them, even if that maybe means increasing the Social Security tax. So that would be one way to fix it. There are some other things. Keep raising the Social Security wage base. Again, different people have different opinions as to what's best, but I think you can count on Social Security. I personally think you can count on what they're promising, but if you want to be careful, just multiply it by 79%. All right. So it'll be there in some form. All right. So let's talk about the basics. 4 things here. Who's eligible? When are you eligible? What benefits can you expect? And how do you apply? All right. So on the who's eligible side, you earn Social Security credits for income that you earn each year. Each year you can earn up to 4 credits or 4 quarters. A quarter this year is $1,470. So if you earn $1,470 of income and you report it to the IRS, you will earn 1 credit. If you earn $5,880 this year, that's a total of 4 credits. If you do that for 10 years, you'll have a total of 40 credits. Now, those credits are inflation adjusted, so year after year, it changes how much you have to earn. Once you have earned 40 credits, about 10 years of making more than about $5,000 or $6,000, once you've earned that, you're called fully insured. That means you're eligible for benefits in the sense that you have qualified. They call you fully insured. Now, how much you receive is going to be based on the top 35 years of income. This is kind of important. If you've worked for 20 years, you're going to have 15 zeros. All right. So every year you work beyond that 20th year, 21, 22, you're going to replace a 0 with an income, which is going to increase the calculated amount that you'll receive. Additionally, they inflation adjust these incomes. So if you made the same amount of money to have the same amount of purchasing power this year that you made 10 years ago, your income has to be higher this year to buy the same amount of milk, bread, and cookies, right? Inflation has demanded that. So the first thing they do is they inflation adjust those 35 years so that they're comparing apples to apples. That helps when it comes to questions related to, well, what if I keep working, but I make a lower income? Does that reduce my Social Security benefit? And the answer is no. If you have 35 years of income, additional income, even if it's a lower amount, won't reduce your benefit. It might increase your benefit if you're replacing zeros. When are you eligible? There are 3 ages I want to talk about. 62 is the first one. 62 is the age at which you first become eligible to receive benefits. But if you do receive benefits at 62 years old, they will be reduced benefits and they will be reduced for the rest of your life. All right, I'm going to say it a couple of times just to make sure it's clear. There are 2 reductions to Social Security you have to watch for. The first is this one. If you start early, you'll have a reduction in your benefits and it will last forever until you pass away. The second reduction is if you start early and then you earn too much money, you make too much money. We'll talk about the limits in a little bit. Then your benefit will be reduced in that year you earn too much money. That benefit reduction will be recalculated at your full retirement age. So that benefit reduction doesn't concern me as much. You're drawing Social Security and you hear that if you make more than a certain amount, you're going to have your benefits reduced, and that worries you. Should I work less? I say if you're drawing Social Security and you love what you're doing, do as much as you want and make as much as you want, because that will be recalculated at full retirement age. All right, that's 62 years old. True or false? You will receive the largest benefit if you wait to file for benefits at full retirement age. Is that true or is that false? You will receive your largest benefit if you wait to file for benefits at full retirement age. Oh, all right. We've got some disagreement. We've got some contrarians. I love it. Very good. How long do you have to wait to receive your full retirement benefit? All right, looks like about 1/3, 2/3. The answer here is actually false. Okay, the next three slides are going to answer that. You actually, if you delay beyond your full retirement age, you'll receive a bigger benefit. Okay, what does your full retirement age mean? Your full retirement age is somewhere between 65 and 67 years old based on when you were born. The full retirement age is when they calculate your PIA, your primary insurance amount. PIA, primary insurance amount. That number represents your benefit, your basic benefit. Now, if you draw before full retirement age, say at 62, you'll have a reduced benefit. If you delay beyond full retirement age, they'll give you an increased benefit due to delayed retirement benefits. Now, practically speaking, what the full retirement age does mean is that your earnings limits disappear. Once you hit full retirement age, you can make as much money as you want, and they will no longer reduce your benefit. And if your benefit was reduced because you earned too much before full retirement age, they'll recalculate at full retirement age to make up for that difference. So when is your full retirement age? Well, find your birth year over there on the left, and then you'll see your full retirement age over there on the right. If you were born after 1960 or later, your full retirement age is 67. If you were born before that, it's 66 and change, 10 months, 8 months, 6 months. All right. That's pretty easy to find if you just go to the SSA.gov pubs. If you search for EN0510035, you can find it there in the PDF format. It's pretty easy. Again, you're going to find if you go to the Social Security website, I'll mention this maybe once or twice, Social Security puts out a lot of really good, really readable material. The IRS material, you go to irs.gov, you're going to find that you got to kind of know taxes a little bit to understand it. A lot of text, not a lot of white space on the page. With Social Security Department, Social Security Administration, much better. So don't be afraid to go to ssa.gov. All right. At 70 years old, this is the third age. So first age is 62. That's when you can start drawing. The next age is your full retirement age. Most of us, it's 67, maybe 66 and change. 70 is the last age I want you to know about. That is when your increased benefits for waiting ends. All right. So you will receive the biggest benefit if you delay, not to your full retirement age, but to age 70. Once you get to age 70, if you haven't started drawing, start drawing. There's no longer a benefit to delaying. So how much does that monthly benefit increase each year that you delay? Is it 2%, 4%, 6%, or 8%? How much do monthly benefits increase annually if you delay collecting? All right, I got a wide range here. And how would you know this unless you'd heard it? The answer is about 8%. Very good. So half of you got it. All right, about 8%. So let's run through an example. This will kind of flesh out all these rules that we've talked about. This is Tom Fuller. I'm going to introduce you to the Fuller family. His full retirement age is 66 years old. That means his PIA calculated for 66 years old is $900 a month. That's his basic benefit. Now, if he draws early at 62 years old, he'll have a reduced benefit of $645 a month. If he delays till 70, he'll have a benefit of $1,224. That's the benefit that Tom Fuller has earned. All right. Who else is eligible for Social Security? Well, spouses are eligible for Social Security. So Tom is eligible either for his own benefit or for half of his spouse's benefit, whichever is higher. And by the way, if he takes half of his spouse's benefit, it doesn't reduce his spouse's benefit. She still receives what she has earned, but it brings up his own benefit. In this case, Tom is married to Sheila. Sheila has a full retirement age of 66 years old. Her monthly benefit at 66 years old is $2,200. That's her PIA, primary insurance amount. That's her basic benefit. If she draws as early as 62, she'll draw a reduced benefit of $1,576 a month. If she delays till 70, she'll draw nearly $3,000 a month. All right, so let's look at them together. If each of them claim their own benefit at 66, Tom will take 900. At 66, Sheila will take 2,200, a total of 3,100 if they both take their own benefit at their full retirement age. However, remember, Tom can take either his own or half of Sheila's, whichever is higher. So Tom is going to take half of Sheila's, 1,100. So Sheila's 2,200 plus Tom's 1,100 spousal benefits, a total of 3,300. All right. Now those aren't the only people that can benefit. Who else is eligible? Well, how about kids? Kids can qualify based on your earnings record if they're under 18 or up to 19 and still in high school. So this is Sienna. Sienna is their daughter. She is 18 years old. She can receive a monthly benefit of half of the worker's full retirement benefit. So Tom's PIA is 900. She could receive 450. Sheila's is 2,200. She can receive 1,100. So she'll receive a benefit of 1,100. Now, there are a lot of other one-off issues here. If Sienna is disabled, she can continue to receive a benefit. If there is a family maximum, it usually ends up being about 150, 180% of the PIA of the primary worker. So there is a maximum that a family, so there's lots of individual little rules. If you got a question about an individual rule, I'd encourage you email Terry and have her email me or email me directly, and I'll answer the one-off kind of things separately. Who else is eligible for Social Security? Divorced spouses age 62 years old or older. They qualify as a spouse if they've been married 10 years or longer, and if they haven't gotten remarried. So let me introduce you to ex Frank. I have no idea why he is an ex. I love this guy. He just looks like he's enjoying life. They were married for 11 years. His full retirement age is also 66. His monthly benefit is $800 at 66, and he remains unmarried. So he can draw his own $800 benefit, or he can draw half of Sheila's, even though they're no longer married. Because he's an ex-spouse and they were married for 10 years, he can draw that benefit. This is important if you're contemplating divorce and you've been married for 9 years. All right, might want to look at sticking it out long enough to qualify. I have talked with folks who've been married for 9.5 years, and they did not, as a result, qualify. So a lot more goes into the debate. I don't mean to imply anything by that, other than just to say, be aware, it is 10 years to receive that benefit. So his own benefit would be $800. His benefit as an ex-spouse would be $1,100. He can take that $1,100 instead of $800, and Sheila won't know, and it won't impact Sheila's benefit. So 2 things to think about quickly, and then I'll try to field some questions if there are some. Number 1, if you collect Social Security early, before full retirement age, and if you continue to work, we talked about that reduction. Okay, here's the details on that reduction. This year, 2021, and this will change year over year with inflation, if you're below the full retirement age, the limit of what you can earn is $18,960 per year. Now, the reduction is $1 of benefits withheld for every $2 you make above that limit. So I make $28,960 this year. That's $10,000 more than the limit. My Social Security would be reduced $5,000. When you get to the year of full retirement age, they have a higher limit, 50,520, and a smaller reduction, $1 for every $3 of earnings. Once you're at full retirement age or beyond, there's no limit. Again, this reduction gets recalculated at full retirement age. So if you retire or if you keep working, but you draw Social Security at 62, and you make so much money that you don't get a benefit at all for 62 and 63 and 64, come full retirement age, 67 years old, for example, they'll recalculate your PIA, your primary insurance amount, your benefit, as if essentially you didn't start drawing until 65 years old. So again, you're drawing Social Security, you love what you do, keep doing it. Make as much as you want. All right, the second thing to keep in mind is as your benefit increases, as your taxable income increases, your benefit becomes more taxable. Okay, so let's talk through how this works. If you are drawing Social Security and if you are doing your taxes, they'll make you do some math. They'll have you calculate your provisional income. Your provisional income for most of us is half of your Social Security benefit plus what you take out of your retirement accounts. If that is under, married filing jointly, $32,000, none of your Social Security benefit is taxable. If half of your Social Security benefit plus what you take out of your retirement accounts is between $32,000 and $44,000, half of your Social Security benefit is taxable, and it's taxable as ordinary income. If that provisional income is over $44,000, 85% of your Social Security benefit is taxable as ordinary income. Keep in mind, Roth distributions don't count here, so here's a great planning tool. If you have a Roth balance, if you can build a Roth balance, do so, and you can find a way, you may be able to find a way to stay under one of these limits. Terry, do we have any questions at this point?
We do. We have numerous, so we'll try and buzz through these best we can. Just let me know if you want to continue on, and we can hold some till the end as well. I'm sure they'll keep coming in, and I just want to reassure anyone that submits questions, I will not reveal the identity of the individual. So first question is, when you talked about what you put in versus what you may get out, somebody said, why is that okay? We should at least get out what we have put in. Yes? Question mark?
Yeah, that's a great question. And if you do the math, you'll find that generally speaking, benefits far surpass what we put in. And I get that complaint from beneficiaries drawing now. And if you do the math on what grandma and grandpa put in, it's very small to what it is now. Now, the answer to that is, this is OASDI, remember, Old Age Survivor Disability Insurance, right? So it's less of a savings plan and more of an insurance plan. And remember, with insurance, you're pooling the risk. In this case, you're pooling the risk that you're going to die, or you're going to live really long. So for all of those who live to 104 years old, there's going to be someone who passes away in their late 60s or early 70s. And that's the function of insurance. So yeah, it'd be nice to make sure that you get everything out that you put in. And for most people that happens, but it is insurance, not a forced savings. So I hope that helps.
Great. And I think you covered this. I just want to make sure that we answered the person's question. Does half of the benefit apply to ex-spouses? And is there a requirement on the length of the marriage or kids from the union? So I think you touched on that.
Yep, you got to be married 10 years. Then if you get a divorce, you're an ex-spouse, as long as you don't remarry before 60 years old. If you remarry after, then it won't change your benefit.
And then does your spouse have to be receiving Social Security in order for you to draw half of their benefit?
Yeah, we're going to talk about that in a little bit. They do have to have applied in order to draw half the benefit. That's for a spouse, not true for ex-spouses, but that should be clear later in the presentation.
And if you did remarry, then you couldn't collect on the ex-spouse's amount, even if it was less than 10 years? So there's kind of a bundle of questions in there.
Right. So if you have to remain unmarried until 62 years old, then you can marry after and still draw the benefit. But the answer is if you remarried, then you've got a new spouse whose benefit you could potentially draw from.
Okay. And can you draw half of the spouse and let yours sit to full retirement age, then change to yours?
Okay, I'm going to default that because we're going to address those in the strategy portion because that's a complicated answer.
Okay. And I think most of these are probably things you may touch on, so I'm going to hold those and then we'll get to the other questions.
Yeah, and if I don't adequately answer that question, please, resubmit it because I'd be happy to go into more detail, but I think we're going to address that. Okay? All right, thanks. Great questions. So how do I find my benefits? Well, you can go to www.ssa.gov. That stands for Social Security Administration.gov. And there are two ways you can do this. Notice you've got you can literally create a login ID and password like you have for your 403B or IRA or other retirement accounts at My Social Security. And then you can sign in and they'll show you what your benefit is. Otherwise, and I do this with a lot of the folks that I meet with, just go to Retirement Estimator and it'll say, estimate my retirement benefits. Click on that button and it'll have a series of fields, including your name, your mother's maiden name, any other name, like a maiden name you might have, what city you were born in, your social security number, and they'll ask you for your last year's income and your last year's salary. You put all that in and they will use your earnings history to give you a projection of your benefits. It's really easy to do. And they'll give you 62, full retirement age, and 70. And if you want to, you can add a different age. What if I retire at 63 or 64? And they'll calculate that for you. So it's pretty easy to get. All right, so what are we going to cover today? Strategies for maximizing benefits. So here's what we talk about. What do I need to do to make sure I get the most out of it that I can? All right. In order to know which strategy is best, of course, we need to know when you're going to pass away. And aren't you glad that we don't know that, right? But if you knew you weren't going to live very long in retirement, you'd want to draw early and get as much benefit as you can. If you knew you were going to live to 110, you'd want to draw later so that you have a bigger benefit, so that bigger benefit can carry with inflation adjusted income for a longer period of time. So absent knowing that, there are a couple of things that we can do. One is to delay taking benefits. This is the easy one, right? The longer you delay, the bigger your benefit becomes. Let me just illustrate this. This comes from a Money Magazine article. This is a sample of a person whose benefit at 62 years old is $1,500. If they collect at 62 years old, they'll receive checks each month of $1,500. Now notice these blue bars at 66, 74, 81 years old, they will receive a bigger benefit due to the fact that Social Security is inflation adjusted. So your benefit check does get bigger with an inflation adjustment, a cost of living change. However, if this person waited until 66 years old to collect, at 66, the check that they collect will be bigger than the check they otherwise would have collected at 66 if they drew at 62. See the difference? So by delaying, the check at 66 is bigger. But some of you are saying, wait a minute, Tim, the guy who drew at 62, he's got 4 more years of checks. Isn't he better off? Yes, he is. And he's better off at 74, even though at 74, the person who delayed is receiving a bigger check. It's at 81 years old in this example. We call it the break-even age. 81 years old, the benefit from starting at 62 and having more checks of a smaller amount is equal to the benefit of waiting and having fewer checks with a bigger amount. That's the break-even age. So in this scenario, if you knew when you were going to pass away, you'd say, am I going to live longer than 81 years old? And if I am, then I'm going to delay collecting till 66 years old. And if I'm not, then I'm going to start collecting at 62. That's the break-even age. All right, now let's get a little bit more granular here. Some folks ask, Well, how do I decide? How do I calculate that? And I'll show you an example. Please don't be concerned if this is confusing. This is a spreadsheet. There's math behind it. I just want to illustrate how we calculate the break-even age. Over here on the left, we've got your ages from 62 to 81. Over here on the right, we've got potential drawing dates, when you could draw, ages you could draw your benefit. So I took example of a person whose full retirement age is 67 years old. His primary insurance amount is $18,000 a year. Now, if that person drew at 62 years old, his benefit would be reduced to $12,600 a year. All right. Now, the projection he was given says if you drew at 67 years old, you'd receive $18,000 a year, but at 62 you receive $12,600. Those projections, and this is important, those projections are always in today's dollars. All right. So if you're 20 years old and you're told you're going to receive $1,500 a month, that means you will be able to buy $1,500 worth of today's goods. That might mean when you hit 65 that you're actually going to receive $3,000 a month, but because of inflation, it's not going to buy you as much. So they give it to you in today's dollars. So back to my example here. If I want to compare this to a person who at full retirement age, notice at full retirement age, the benefit check is no longer $18,000 for a year. It's going to be $19,391 because of inflation. All right, so you can see how that happens. So basically what we do here is we just add up the cost of living increasing adjustment benefit each year. So each year we add this field to this field, inflation adjusted, then add this year, and then add this year. We have accumulated benefit that's building in each column. When the benefit for drawing at 62 is the same as the benefit for drawing at 70, you have your break-even age, which in this case is 77. Okay, sounds confusing? Maybe a little bit. This chart may help. This is from FIGuide.com. It's break-even points for different ages. All right. So down the right side, you see what's the difference? How long do I have to live to have delaying to 63 rather than drawing at 62 be beneficial? Well, here's 62. Here's 63. I have to live to 77 years old in order to have delaying 1 year from 62 to 63 be beneficial. All right. And you can see different ages from 69 to 70. It's actually 85 years. Now, think of this as a 12-pound sledgehammer. This is not a jeweler's screwdriver. All right. Talked to a lot of folks who say, help me calculate whether it's more beneficial to draw at 67 and a half or 68 and a quarter. And if you look at the difference between 67 and 68, my goodness, you're talking about 1 year. Who at 66 or 67 years old can accurately predict whether they're going to live longer than 80 or longer than 81 years old? The answer is you can't. So it's not a real fine adjustment, but do use it as a big picture adjustment, right? So how long did mom and dad live? How long did grandma and grandpa live? How long did your spouse's mom and dad and your spouse's grandma and grandpa live? Are you more healthy or less healthy? If you're more healthy than them and they live to their late 80s, by all means, delay, because it's very likely that you'll outlive that retirement age. But if all the males in your family pass away at 72 years old from the same ailment, and you're as healthy or less healthy than they are, by all means, start drawing early. So think of this as a course adjustment, not a fine adjustment. Hopefully that perspective is helpful. The second, and this is what a lot of folks were wondering about, coordinating spousal benefits. This is something that you can do. It's changed a little bit, so I'm going to give you the ground rules for spousal benefits. Number one, this is the answer to your question. You cannot collect on a spousal benefit until the worker files for their own benefit unless they're divorced. All right? So if you're divorced, you don't have to wait for your ex-spouse to file. If you're married, you do have to wait for your spouse to file in order to draw benefits. Number two, that spousal benefit or ex-spouse benefit for that matter will be reduced if you collect before your full retirement age. So you collect at 62, you'll have a reduced benefit. It will not increase beyond your full retirement age though. So while your personal benefit will increase beyond full retirement age all the way up to 70, your spousal benefit will stop increasing at your full retirement age. So there's no longer any benefit to delaying if it's a spousal benefit. Okay, so one strategy is have one spouse wait to collect. Let's see what this might look like. This is Tom and Sheila. Remember, these are their numbers. We could have Tom start drawing at 62 years old. He would draw a reduced benefit of $645. Now, this is important. There is a new deeming rule, just added a couple of years ago, a deeming rule that says if you file for benefits, you are deemed to have filed for the largest benefit that you can receive. In this case, the largest benefit he can receive is $645. He can't receive his spousal benefit yet because his spouse has not yet started to collect. All right, so he can draw his own benefit. Now, when Sheila starts collecting her benefit at 70 years old, she receives now her bigger benefit, almost $3,000 a month. He can now collect his spousal benefit, which is $1,100. Now remember, Sheila's going to start collecting at 70. They're the same age. So Tom will switch at 70. He doesn't get any increase beyond 1,100 because the spousal increase stops at full retirement age. So he can draw his own until she files. Once she files, then he switches to his spousal benefit. I think that answers the question. There's more to it. You can also collect a survivor benefit. Surviving spouses can collect on a deceased worker's record if you were married for at least 9 months. They can receive 100% of the full benefit at full retirement age, but it will be reduced if they start collecting early. They can draw for a survivor as early as 60. So typically it's 62, but if you're a surviving spouse, you can draw as early as 60 years old. So what does that look like? Remember that situation where Tom is drawing his own benefit. Let's say he's drawing 900 now, and Sheila delays. She delays till 70. So now she's drawing 2993. Okay. If Sheila passes away at 71 years old, that delay is not wasted. Tom gets to assume her benefit if it's larger. Okay. So guys, if you really love your wife, and if you have a higher benefit, perhaps delay taking your own benefit, because typically we die first. They typically outlast us. All right. You can then give her the benefit of your delay because she gets to take whatever the biggest benefit is at your passing. All right. So that's something to keep in mind. All right. Collecting survivor benefits. Divorced spouses can also claim a survivor benefit. Again, if your marriage lasted 10 years. If entitled to both the survivor benefit and your own benefit, you can begin to collect one, then switch to another at a later date. So remember this guy, Frank? All right, remember, if he draws his own benefit was $800 a month, but because he was married to Sheila for 10 years, he's entitled to half of hers, or 1,100. And if Sheila passes away, he can then take $2,200, a survivor benefit. And again, this is not something that impacts Sheila's benefit. It doesn't impact Tom's benefit. They don't even know it happens. Now, this is important. If you're no longer in the sphere of, you no longer have any relationship with your ex-spouse, you may not know when they pass. Usually funeral homes, morgues will often notify Social Security if someone passes, but they may or may not. Social Security may or may not know if you are eligible based on their earnings history. So if you don't know about your spouse's situation, but your spouse you may be subject to this beneficiary change, you might just want to call the Social Security Administration office and ask, or let them know, hey, I'm potentially eligible for a survivor benefit. is that person still alive? And you can get your benefit backdated up to 6 months. So if you were not able to claim a benefit because you didn't know he passed, you can do it up to 6 months. So check every 6 months. Say, is he still alive? Is he still alive? Sounds kind of morbid, but otherwise, if they know that you're a potential beneficiary, an ex-spouse beneficiary, they'll let you know. But if they don't, then you got to go check. All right. Here are a couple of the real fantastic strategies that we used to teach you that are no longer available. All right. The first is file and suspend. With file and suspend, a higher wage earner, in this case, say Sheila, she applies at her full retirement age, which remember was $2,200, but then she suspends her benefit. She says, I want to get my name in, but I'm not going to take a benefit. That allows my benefit to grow. All right. Now what can happen? The lower wage earner, in this case, Tom, he can start his spousal benefit, which is $1,100. Now, the higher wage earner, Sheila, when she hits 70, she starts taking $2,993. And all this time, Tom was able to take $1,100. This is no longer allowed. Remember, it's that deeming rule. When you apply, you're deemed to take the biggest benefit available to you. Now, you can still do this if your full retirement age was before April 30th of 2016. So if you're a little bit older, you may still qualify for this. Restricted application was the other one that was kind of cool. A wage earner could restrict their benefit to only their spousal benefit, then switch over to their own later. So you file, you say, I don't want my own benefit, I want my spousal benefit. So you have the benefit of receiving the spousal benefit, but your own benefit gets bigger and bigger and bigger. Then at 70, you switch over. Now when you file, because of the deeming rule, you are deemed to have filed for whichever is the biggest, yours or your spousal benefit. You can still do this if you were born before 1954. All right, so where to learn more, visit ssa.gov or call them 800-722-1213 or visit a local office. Okay, a couple of things related to actually applying. You can apply for benefits 4 months in advance of the month that you're actually going to take the benefit. So if you're going to turn 62 years old in July and you want to start taking it 62, apply 4 months in advance. You're going to fill out an application online. For most of you, if you're a surviving spouse, you can't do it online. You actually have to call them. Okay. Most of us will apply online. They'll review the application and they'll tell you this is how much you'll receive when you start receiving a check. If you want to dispute that, you can. There's 4 different ways to do that, including going through the courts. And then you'll start receiving the benefit the month after the month that you've selected. So if you want to draw at 62 and you turn 62 in July, your first benefit check will be in August. Now, the other thing that I would encourage you to do, if you're going to apply early. When COVID hit, there was a real strain on the Social Security Administration office. They closed the office. In fact, I don't even know if they're open for visits. You'll have to check. But there was limited access to the Social Security Administration. They got behind. So if you filed late, there's a good chance that your benefit check was delayed as well. So start early so that there is anything like that unforeseen global pandemics, for example, you get your application in early. The other thing I want to say about the local Social Security office, every individual I've sent to the local Social Security office that have gotten back to me on it have reported a very good experience. All right. You may have had a bad experience at another government office, and often that's because a government office is, understaffed, or like the DMV, they care for so many people there that you got to wait in long lines, that kind of thing. SSA is not like that. So if you have a unique situation, survivor benefit, you've got a divorce or two, and something's going to be unique for you, I would say give them a call, try to set up a time to go and visit the local office. They will try to direct you to the web. Got a lot of information there, But boy, it really is good to go and sit down and talk to someone. They'll be able to give you what your benefits are, answer any questions you might have. I think that covers what I wanted to address here. I'm going to switch over to this slide. This slide actually has my email address on it. If you want to email me a question, please feel free to do so. Otherwise, if you want to go through Terry, you can do that as well. Otherwise, Terry, I'm going to open it up for questions at this point.
Okay, we've got many, so I will try and go through as fast as I can. One of the questions is, what if the wife makes more than the spouse? So I think you've covered that a number of ways, looking at who earns more and which benefit is higher.
Yep. So the Social Security Administration office is right where it's probably agnostic or ambivalent related to your gender. All right. So if the wife makes more, the husband can go on the wife's benefit as spouse. If the husband makes more, spouse, vice versa.
And this is an easy one as well to answer. You're suggesting to apply 4 months in advance, at least 4 months?
Yeah, thank you for letting me reinforce that. In your application, you set a date when you want to start drawing. So if you're going to apply at 70, for example, 4 months before you turn 70, get your application in there. I think you can backdate it 6 months if you're over full retirement age. So if you missed, you're hearing this now, I said, oh, I'm 71, I should have applied. Apply now. And I believe if you're over the full retirement age, they'll send you checks for the last 6 months.
And you mentioned benefits are based upon the top 35 years of income. Is that consecutive years or just the top 35 years as a whole?
It is not consecutive. It is the top 35 years as a whole. And again, it's inflation adjusted. So you may have made $40,000 10 years ago and $50,000 today. The $40,000 may be actually higher than the $50,000 today. So 35.
Is the Social Security benefit sent to the recipient or deposited in an account? Or are Medicare charges deducted first? Do you know if Social Security and Medicare work together?
Yeah, so Social Security and Medicare do work together a little bit. If you got some of your Social Security premiums can be deducted from Social Security. If you're not yet drawing Social Security, then of course it'll be a check that you'll be billed. You have to send them a check. I believe you can set up a bank if you link your bank account. I believe you can do that. I'm not an expert on that. I actually haven't gone through that process myself. I know in the olden days it was a check, but I'm pretty confident. I mean, I can check that out for you. Otherwise, go to ssa.gov and just look at. You know what? Let me find that for you, Terry, and I'll give you an answer on that. I'm confident the answer is yes, but I don't want to. I'm not that.
Okay. Good enough. Was planning on retiring at 62. If I pull out money from my IRA or 403B, does the income from those accounts count against the SSI income limits that trigger the benefit reduction?
No, they do not. That would just be earned income. So it'd be like W-2 kind of income. So income you earn from the medical college would count against that limit. What that would count against, though, is your provisional income, which is what you calculate to see whether or not your Social Security benefit is taxable. Great question.
Yeah, very good question. And if your spouse passes away, when can you collect benefits, at your retirement age or your spouse's age?
So if your spouse passes away, you can start drawing benefits as early as 60 years old. Okay. Now, there's some fine tuning here, because if you have a child that you're still caring for, you can continue to receive benefits before. You can get benefits before then if they're 18 or 19 and still in school, or if they're disabled, you can still get those benefits. But otherwise, you can draw as early as 60. It will be reduced if you're drawing before your full retirement age. Now, if they pass away after they started drawing, then whatever reduction they had due to when they started drawing, that would be carried over to your survivor benefit. So, you know, if Tom started drawing at 62 years old, instead of $900, he's got $600 worth of benefit. Then if he passed, Sheila's survivor benefit would also be reduced because they drew early. If he passes away before he starts drawing, it's full retirement EIA.
As we mentioned earlier, this is complex information. So one of the notes in the comments is this is being recorded. So we will make the recording available and we will also share the slides. I know some of you are trying to take notes feverishly, so we will be doing both. Can you please repeat what was said about remarrying after 60? I think it has related to what benefits you may be eligible for or not.
Yeah, so if you remarry before, if you remarry before 60, then you will not be eligible for a survivor benefit. If you remarry before 62, you will not be eligible for, I'm thinking I'm getting that right. Now you're questioning me. You will not be eligible for your ex-spousal benefit. I'd have to check on that for you, and I can check on that if you'd like, Terry. But if you marry after that, then you can still be qualified. You can still receive that survivor or ex-spouse benefit.
Okay.
Remarriage age, and I'll send that to you, Terry.
Okay, thank you. Are Social Security benefits taxed by the federal government or the state?
Social Security benefits will simply be income for you. So it will be included in your income, and it'll either be none included or 50 included or 85% included. So if my income that I draw out of my retirement accounts is 20,000, and I draw 40,000 out of and I receive 20,000 of Social Security, and half of that Social Security is taxable, my taxable income will be 30. So it'll be treated, and the taxation will be based on what state you live in. So Tennessee, no. Otherwise, it'll just be ordinary income tax, part of your adjusted gross income.
And do you have a chart, and you may have covered this in that larger chart where you were kind of amortizing it out, the break-even point. Do you have a chart or number of what age is the crossover point, that if you delay your benefit, you end up getting more total benefit? Is that around 83 years old? I think your example was 81 years old.
Yeah, it depends on which ages you're comparing. If you're comparing 62 and 63, it's going to be really young, like 77. If you're comparing 69 and 70, it's going to be later. It's going to be 85. It's going to be somewhere between late 70s and early 80s. If you Google FIGUIDE, FI Guide Financial, FIGUID Guide, FI Guide, and then break-even age, you'll see that chart. That's where I got that chart. But again, let me just reiterate, 12-pound hammer, right? Not a fine-tune adjustment, very coarse adjustment.
And you said that was FI and the word guide?
GUIDE, yeah.
Okay. We can maybe add that link onto the retirement and financial wellness pages. If I start Social Security at full retirement and my husband doesn't start until say age 70, when he retires, can I receive half of his Social Security amount, assuming it's more than her current?
Yes. Yes, so you start drawing your own and he has not filed yet. So you're deemed to take your biggest amount. Your biggest amount is what you've earned. Now you can't take his benefit until he files. He files at 70. Now you're eligible as an ex-spouse. If half of his is bigger than yours, then you can take half of his. That is correct.
If the spouse collects early with a reduced benefit, when the worker retires, wouldn't the spouse receive a reduced amount as well? Less than half of the worker is what their thoughts are.
Okay, so run that by me again.
If the spouse collects early with a reduced benefit, when the worker retires, wouldn't the spouse receive a reduced benefit as well?
Yes, so Sheila starts drawing early. So rather than 2,200, she's got 1,100. And then when Tom retires, when he retires, he would have his own benefit that he's earned or half of the reduced benefit that Sheila has. So that reduction does impact his benefit.
Okay.
That is my understanding.
Yeah,
But again,
that helps clarify.
Yeah.
Based on some of the examples you've covered. Can I retire at age 68 and hold off collecting until age 70 and receive the higher age 70 benefit rate?
Yeah, so if by retiring you mean stop working, you can stop working whenever you want. Social Security Administration doesn't consider that drawing benefits. Drawing benefit happens when you apply for Social Security. So in that example, you stop working at 68, you have other income, either from your 401 or 403B, or maybe you're saving, something like that. 2 years later, you apply. The benefit that you receive due to delay is the benefit because you delayed applying, not because you continued to work.
So basically what you're saying is there is not a penalty, so to speak, to continue to work. Social Security isn't penalizing
Right.
you in that way.
Now, it's possible that at age 68 and 69, you may have had a higher income, and you may have added a higher income to your 35, and maybe bumped up your primary insurance amount a little bit. But the reality is they don't care if you're working for those 2 years or not. You get the increased benefit because you delayed applying, not because you continued to work 2 years.
And kind of an addition to that question is if my spouse passed away at age 59, if I wait to collect his benefits until I turn 70, will his benefit be paid to me at his age 70 rate? So it has to do with the spouse's rate.
Yeah, so
age.
Your spouse would have achieved a certain PI, qualified for a certain primary insurance amount. That primary insurance amount would be calculated based on 65, or I'm sorry, 67, whenever the full retirement age is. So you would be eligible for, since you're a surviving spouse, you would be eligible for 100% of his primary insurance amount. You could draw it as early as 60 years old, but it would be reduced. It would be increased until you got to your full retirement age. At that point, you would receive 100% of his primary insurance amount.
Okay. If you are divorced, married for 12 years, so you hit over that 10-year mark, you draw half of his benefit at 62, can she change her benefit at full retirement age?
All right, now I'm starting to lose them all. My understanding
We're getting
is that,
quite complicated here.
my understanding is that divorce. My understanding is that you can take your ex-spouse, okay, let me take a name, and I'm gonna get this one before I give it to you. I know if you're a surviving spouse, that you can take your surviving spouse benefit and delay your own benefit until 70, but I need to verify that you can take your ex-spouse, non-survivor ex-spouse benefit and then delay your own benefit. So I have to check on that. So hang on just a moment.
And let me just check in the meantime. I think I've gotten, here's another one. So let me copy that.
So what I will do, Terry, I'll come up with an answer because I'll just go to the Social Security website. There's all sorts of great material there. I'll pull one of those. I'll send you a link that has the information, and then I'll summarize it in the email to you. You can just forward it to that person. If anybody else wants that question answered as well, have them reach out to you. I'd rather give it to you with a link from Social Security rather than try to clear my cobwebs out. Apologize for that.
No, that's perfect. I mean, we don't necessarily have all the scenarios covered here. We're trying to answer the best we can. So if we need to do a little research, that's totally understandable and reasonable. And I've noted the individual's names so I can share that with them privately.
Okay.
Another question, are you paid the first of each month or twice a month?
That depends on when you're paid depends on when your birth date is. If your birthday falls in the first 10 days of the month, you're paid a certain point of the month. The next 10 to 20, it's another point. So it's one check per month. But when the check actually comes in is based on when your age is. If you want exactly when that is, I can send that table. I don't have it memorized. I can send that table to Terry if you want it.
And I'm happy, what I can do is just email everyone as I did with some of the other information for some of the other sessions. Do that BCC, and I know we're over time, so I have one more question here and then we'll wrap it up. My wife, lower income than me, retires early at reduced benefit. I retire at full or later age. My wife will not get the full half of my retirement benefit, but rather a lesser amount because she retired early.
So in that situation, because he hasn't applied for benefits, when his wife applies, the only benefit that she can receive is her own. She's not eligible for a spousal benefit yet until he files. So when she applies, she can apply for what she's earned. She can't apply for her spousal benefit. Now, when he applies, then she's now eligible for her spousal benefit. So she will switch to her spousal benefit if it's larger than her own personal benefit. You want to run that question by me again, and I'll make sure I answered it right.
My wife has lower income than me, retires early at a reduced benefit. I retire at full age or later retirement age. My wife will not get the full half of my retirement benefit, but rather a lesser amount because she retired early.
Yeah, I don't. Let me check on that. I think there's a difference to it. He's saying because she retired, because she started drawing her benefit early, will her spousal benefit be reduced? I think is what we're getting at.
I think so too. I would agree with your assessment there.
Yep.
And again, I've just noted the individual who asked, so I can respond to them specifically and privately. So I think I've captured all of the questions. They were great. We had many, which was wonderful. I apologize if I missed anyone. As Tim mentioned, we'll get back to everyone that had specific questions privately. And this is recorded, so I can share that recording once I receive that link. And then we will post it on the financial wellness page as well as the 403B retirement page. And our next session is on Tuesday, May 25th from noon to 1. It's turning assets into income, retirement income planning. And then also Tim will be returning on Thursday, May 27th, so a week from today, all about long-term care. So those are our last two sessions for the series. So thank you, everyone. Thank you, Tim. I know we pummeled you with a lot of good questions, and there's a lot to learn about this topic, as we can tell. It's quite complicated. So we appreciate your expertise, and everyone have a great afternoon. Thanks for joining us.